Welcome to Petroleum Follies 5, Peak Oil 2 Capacity. This video lecture is produced by Michael Lynch. It is based on my book, The Peak Oil Scare and the Coming Oil Flood, which covers the peak oil arguments as well as many other aspects of oil supply. In my previous peak oil lecture, I discussed the bad estimates of resources that were used to predict a near-term peak that is somewhere around 2005. And in this lecture, I will discuss the second wave of peak oil arguments, which were about capacity, that is, the ability of the industry to produce. People have noted as evidence of this the fact that prices have gone up quite a lot until recently. They often say, you know, we did predict this, although prices did not behave as they predicted generally. We didn't see $200 or $10 gasoline. They note that non-OPEC supply has been growing slower in recent years, that costs have soared. They roughly tripled from, say, 2003 to 2013. Resource nationalism has become a growing problem, they say, and the industry has a lot of problems which will make it hard for them to maintain production. And this graph does show, in fact, non-OPEC, non-Soviet Union, former Soviet Union oil production growth. And although we do see some sharp growth in the last couple years, that's all shale oil. But generally, the rate of growth is much smaller than what we experienced in the 70s, and even sort of 95 to 2005. Now, cost. I've already mentioned in the previous lecture the easy oil is gone argument, which is just more or less nonsense. It doesn't mean anything to divide oil into easy and hard, and it didn't suddenly go away. But people say, you know, we're going to harsher and harsher environments. Costs have tripled. Equipment has gotten so much more sophisticated in order to get more oil out. We're drilling deeper water, and going to unconventionals. Back in the day when I was a lad, the unconventionals were called the backstop technology. And the idea was that the price of oil had to rise exponentially until it reached the cost of backstop technology, which was kerosene. Related to this, people say that the energy return on energy investment has been going down, and that the switch from conventional to unconventional fuels like oil sands and shale oil signifies this. However, these estimates are very fluid, and frankly, it's not a very useful measure. Now, this is a typical supply curve, and you can see this was done in 2010, and you can see that the argument was that, well, conventional oil was $40 to $60, but you move quickly into the $60 to $100 range, and a substantial amount of the oil that's out there is actually cost above $100 a barrel. That's looking at reserves. If you look at a dynamic view, that is 2 different years, the cost curve in 2 different years, 2003 and 2008, you can see that there was a huge shift in a 5-year period. Where did that shift come from? Well, you'll notice that most of those are essentially the same countries. The costs, we didn't use up all of the Saudi oil and Iraqi oil and Mexican oil and have to move somewhere else. The costs have not really changed except from a cyclical perspective. That is, because of high upstream investment and high demand for goods and services, drilling rigs, and skilled personnel, the cost of all those things went up very sharply. Someone told me that in Australia, people could make $200,000 a year flipping burgers, working on some of the LNG plants in isolated places. I kind of find that hard to believe. But I did note that Burger King in North Dakota near the Bakken oil fields was paying entry-level workers at twice the minimum wage, which I think signifies that costs there had become inflated quite a bit, not because of the difficulty of producing oil, but because of the tight market for services. Another argument made is the gray wave, that a lot of people are going to be retiring because there was a big surge in hiring in the 1970s where prices were very high, and people are worried about replacing all of these very skilled and experienced geoscientists and petroleum engineers. And, you know, there is truth to that. On the other hand, equipment is getting much easier to operate, much more automated. People are using more computer programs to take the place of some of the expertise, and you don't have to travel to an oil field to look at a seismograph. In real time, you can do that over the internet now, saving yourself huge amounts of travel time. And frankly, this is hardly the first time people have worried about that. This is an article from the Journal of Petroleum Technology in 1962. The quote about the fact that there have been shortages in the past because of people not hiring and people not studying in the field. The industry also faces what is called the Red Queen problem, after the Red Queen in Alice in Wonderland, who said, "You have to run just as fast as you can just to stay in place. If you want to go somewhere, you have to go even faster." And the argument is that oil fields decline, so the industry constantly has to invest and add capacity, not to raise production, but just to offset that decline, which means that it's ever harder to meet rising demand. This is why people say you're running faster just to stay in place. And it's a function mostly of hydrodynamics. That is, if you produce a certain percentage of reserves, that is proved reserves, then production will decline by roughly that percent. Again, you have to be using proved reserves. This is sometimes called the natural decline rate. You should not confuse it with rate of decline that some people use, meaning the production trends. So you can look at a field and see it decline by 5%. That is the rate of decline, but not the natural decline rate, because as the field declines, people put in more wells, enhanced recovery, and so forth to offset that. And you usually don't know what that is. So you really don't have a good case, empirical evidence of the natural decline rate. Rather, you have the observed rate of decline, which is what most people wind up measuring. And especially Matt Simmons, the famous peak oiler, argued that the new smart wells, like maximum reservoir contact wells, meant higher depletion rates. He called it SUPERSTRAWS technology, and said what happens in modern times is that fields decline faster. Now, there's a number of problems with it. First, when you look at the SUPERSTRAWS fields like the ones he mentions in his book, you find that they all started declining long before the SUPERSTRAWS technology. In fact, especially for offshore fields, decline rates tend to be pretty rapid, and you see this for 3 of the fields in the UK North Sea. So they were essentially observing an existing trend, something that's been around since the early days of the industry. As I say, this is nothing new. Here we have a 2008 graph from the International Energy Agency. You will see this type of graph very often. The light blue shows existing capacity, and you can see how it declines over time and how the industry has to invest quite a bit, add a lot of capacity over 20-25 years just to offset that, let alone to raise production. Now, the first thing you'll notice, though, is that this doesn't tell you about historical decline. It just shows you the decline going forward, and it's cumulative. They don't tell you how much needs to be done every year, and people will often cite an amount and say, oh my God, we need to invest to add 5 million barrels a day or 4 million barrels a day just to offset existing decline. The reality is that we've been doing that for many years. This is calculated using production and proved reserves. The OPEC numbers are not as reliable as the non-OPEC on the bottom. You can see that, the industry has been adding 5 to 6 million barrels a day for just about 20 years. So, the idea that they need to do this and that people are so shocked at the challenge ahead is a little bit misleading. It just shows that a lot of the people talking about this don't have a sense of the industry, the structure of the industry, its historical challenges, and so forth. One of the biggest problems with the decline rate argument is it assumes that there's a constant or scientifically driven trend, and what the empirical research has shown is that there seems to be an increase over the long term, but relatively gradual. There is dispute about that. But people like Kjell Aleklet and Jean Laharère, peak oil advocates, will point to existing field trends and say this shows that once a field is in decline, the decline is very steady. This example is the Thistle field in the UK North Sea. However, the data ends some years ago when the British government stopped publishing it, and it does look like you have a very steady rate of decline, which would imply that you could extrapolate it out into the future. Unfortunately, you cannot. The field stopped declining over a decade ago, has been relatively constant thanks to additional investment, which means that the rate of decline, if you take production out like this and then you measure the decline from the current point back to the beginning, you get something like this. This is the rate of decline measured back to the beginning of production, and you can see it did increase for a while, and it was about 9% for some years. However, because of the flat production trend in recent years, that means that the overall average decline, that is rate of decline per year, has gone back up to about 5%. So this just shows you that you cannot rely on these kinds of measures or arguments. They are very popular because measuring decline rates is very difficult to do, and very few people do it. So it's one of those, sort of technical things that people throw out, kind of like Bill Murray in Ghostbusters when he goes, "It's just one of our little technical tricks." Now, another argument people have made is that it's taking more and more energy to produce energy. They refer to this as energy return on energy investment. And the argument essentially is that if you're spending as much energy to make the energy you use, it's just not profitable. It's not viable. And if you look at things like oil as opposed to renewables, you find that in theory, the amount of energy you use increases over time as your resource is depleted. This is not significantly different from the basics of resource economics, and like so many supply models, it ignores the fact that there are dynamic factors at work in both the short and long term, specifically the improvement in technology. So this simply shows that you lose a certain amount over time, through the different processes of producing oil. And here are some empirical results from a number of research projects over the years. And one thing you'll notice is that if you looked at the 1984 publication by Cleveland et al., the energy return on energy invested was heading towards zero, and in fact they did show that it would probably reach zero somewhere before 2000, suggesting that U.S. oil production would more or less cease. That proved not to be very accurate. You can also see where Hall et al. Have added dates, events to some of these, and the reality is what you see over time is people who measure the energy return on energy investment are usually looking at the expenditure on energy by the producers. And when oil prices go up, those expenditures go up. When oil prices go down, they go down. Also, if you develop new methods of production, for example, in the oil sands, like SAGD, steam-assisted gravity drainage, you may find that you've greatly reduced the amount of energy you need. Similarly, shale oil, people have come up with much better production methods, and it looks like that's going to prove to have a substantial return on investment, as it were. The fact that people are able to not only pay for energy, but all the labor and materials and still make a profit suggests that energy is a very small portion of oil production. And if you look at other sources, you'll find that, in fact, oil and gas production do not use a lot of energy compared to some of the other methods, and the idea that it's declining rapidly is essentially empirically false and a myth. And it is true that the oil industry has complained a lot about resource nationalism in recent years and lack of access to resources, and this is partly due to the backlash after the 1990s, when a number of countries like Argentina, Russia, and Brazil started opening their upstream sectors, and then we saw some of that reversed. Our good friend, the late Hugo Chavez, with his good friend, the late Fidel Castro of Cuba, exemplified this in many ways, where he announced he did not like foreign oil companies, or at least felt that they had gotten too good a deal, and therefore he raised taxes, took more ownership of projects, and so forth. And Venezuela had been a country that famously opened up the apertura, which made a big difference in their oil production. People look at that and say, well, this is a big problem, but it's not new. Here we have, again, our late friend Fidel Castro. However, he's with Canadian Prime Minister Trudeau. You may not recognize him because this is the father of the current Prime Minister, Pierre Trudeau, who in the 70s and 80s worked to remove foreign influence from Canadian oil, specifically American oil companies, the big bad American oil companies, and undertook a number of policies that cost his country billions. In point of fact, there's been political risk in the oil industry since, I believe it was 1863, when General Jones burned down some oil wells. Confederate general, no relation to yours truly. And it's something that the industry has coped with pretty much forever. So what are we left with? Well, like cloud rains, we find that peak oil advocates are often shocked to find gambling or water cut or fuzzy logic in this establishment. You know, Paul Roberts in his book said his jaw dropped when he heard what the Gawar water cut was. He didn't bother to check, even do a very quick Google check to find that the Gawar water cut is not, in fact, very high. It's relatively low compared to the global average. Matt Simmons said he became suspicious that the Saudis were having troubles when he heard they were using fuzzy logic to model their oil fields. Again, Wikipedia would have told him that fuzzy logic is just a programming method that's been around since the 1960s. And Shel Alaklet, I have seen him explain to people that oil doesn't just flow like water out of a bottle. You have hydrodynamic principles that cause it to flow slowly, and that leads to decline rates in oil fields. Of course, he says this as, I guess, a physicist who had not realized this until he began studying oil about a decade ago. The fact of the matter is, all of the problems that people have described as potentially causing peak oil have been around pretty much forever. None of them is insoluble. They are, I would say, not so much obstacles as challenges for the engineers or occasionally the contract lawyers. but we don't really see any sign that there's any reason to believe that peak oil is nearer in terms of the ability of the industry to raise capacity to meet demand. So what do we do? Well, let's face it. As the gentleman here, Albert Einstein, once pointed out, everybody's stupid about something. We all are. I certainly would not pretend otherwise, but we can try to minimize that by listening to the gentleman on the right, King Solomon, who once famously said in Ecclesiastes, "There is nothing new under the sun." History repeats itself quite frequently. You can learn from it, but unfortunately a lot of people do not, and what we have seen is that a lot of the people worrying that the industry's current challenges represent imminent peak oil are simply not familiar with the history of the industry, which is a shame. This is why you should always be careful about listening to people who, let's just say, they're pretty much novices in the industry or to the aspects of the industry that they are discussing.